First of all, I would like to welcome our guest, Dijego Kinjones, who came from Oxford to be with us today. Before I introduce Diego, there is one announcement. From this tax evening, we are going to be filming them. So the initial lecture part of the today is going to be filmed, edited, and then we're going to put it on YouTube. So we are going viral. However, so that we don't impede your Q&A session, the Q&A sessions will not be filmed and they will not be posted online. So feel free to ask questions after the presentations. Now, Dijego Kinjones is one of the people that who's a part of our strategy. We're not the most important part of the world, so we're trying to get them young. And Dijego is definitely one of the young stars of the tax heaven today. Maybe we're a bit late. He's not that young. He's already quite well known in the tax community. He comes from Colombia, where he's a partner with the Quiñones Cruz Avocados firm, the biggest tax firm in Colombia. At this moment, he's a PhD candidate at Oxford with Judith Friedman, and he holds many degrees, speaks 5-6 languages, Diego today is going to talk with us about tax morale, risk, and abuse. What is, I think, important for us is also that you were on 2 panels at IFA Brazil this year, so we are getting somebody today those who can, get anyone chose to have with them. So we're really honored, and it's a privilege to have you here today. So I'm having giving Diego the word now. Thank you.
Right. Well, thank you, everyone. Thanks to Professor Kostic and to Dejan Rakovic and IFA Serbia for hosting me here. It's lovely for me to come to Serbia first time. Wonderful country. I've read a lot about its history. Hopefully, I'll get a chance to see around some of the history that I've read. So what I'd like to guide you through this conversation is a little bit about abuse, but also a little bit about how companies behave themselves, how they think. Right? It's not only an issue of where are we talking about in terms of a subject out there in the clouds or in the ether. It's about how the people that are interpreting the laws actually think, so that you can come and tell them, are you behaving abusively or not, based on how they behave rather than a parameter which is abstract and no one understands. So when we talk about tax morale there, which is in the title of the presentation, the first thing that I need to say is don't confuse tax morale with tax morality. It's 2 different things. So tax morality is normative. We're talking about what's right and what's wrong. That's not tax morale. Tax morale is a concept which encompasses the ideology of a taxpayer. How does a taxpayer think? How do they approach the idea of taxes? So you can't say a person has the right or the wrong tax morale. They just have different tax morales. Some of those tax morales will embrace abuse. Some of them won't. But that's part of what's interesting. Don't think about morality there, right? And we're also going to talk about risk. So risk is composed of many types of behavior. Abuse is just the most egregious one of them. But you can have risk for accidental non-compliance, for example, errors. You might have a lot of behaviors that will land you high on the risk, but low on abuse. So we're also going to talk a little bit about how companies around the world are trying to assess tax risk, including or not including tax abuse, right? So initially, I wanted to start going through the part of abuse. So can you hear me already if I stand up? Do you think that I need the microphones, or do you think you would be able to hear me if I'm standing and walking?
You can stand and try.
Yeah?
I think we'll hear.
Well, I can try it, because it's better. It's a little bit more interactive, right? So, traditionally, we thought of tax compliance in terms of outcomes. At the end of the day, once I've filed my returns, once I've paid the tax, am I compliant or am I not compliant? That's how we traditionally saw the world of tax. And we said X is compliant or X isn't compliant based on whether X paid what the letter of the law said or whether X filed their tax returns on day Y if the law said file them by day Y, right? The issue is that allowed for a consideration which is very narrow. Tax is only the tax that's in the letter of legislation. So we have to move to a substantive outlook on compliance. And this is not exactly new. I'd say it's about 20 to 30 years on the making. It's just that in the last 10 years it's exploded with a vengeance, right? So if you talk to practitioners that have been working for more than 10 years, I'm sure that a lot of them would tell you about it before and then after, in their practice, in the type of litigation that they handle, in their planning, and it has to do with this shift, a shift from the outcome to the substantive. So now I'm worrying about not only what the letter of the law says, but am I matching the intention of the law with my actions, right? And this is the type of analysis that will get you into abuse or non-abuse. Is what I'm doing in alignment with what the law wanted? But obviously, that's a difficult question, right? So this trend is also in line with the substance over form trend, which is a trend that originated with the judges. And it originated with the judges and not the legislative. And this is something interesting, right? It was through the practice of cases that people started to realize, well, there's something wrong about what some taxpayers are doing. We see that what they're doing is within the letter of the law. We don't necessarily like the outcome, so we have to change that. And through judicial activism, first in the US, eventually in the UK, we had substance over form regimes. So for example, in the case of the UK, you passed on from IRC, the Duke of Westminster cases in the early 20th century, in which the taxpayer that obtained the least tax was actually praiseworthy, was clever, was ingenious, to cases like Ramsey, later in the 20th century, where they're punished because there's a limit to your ingenuity. If your ingenuity consists of defrauding your other citizens, we might have a problem, which is the purposive approach. What was the purpose of the tax provision that you're actually trying to engage with? But bear in mind that, again, this is not an issue of what's right or wrong in terms of your natural sense of justice. It's what the purpose of the law wanted. You might disagree with the purpose of the law, but if the taxpayer acted in accordance to the purpose of the law, they're still fine. So for example, if the parliament concludes from now on that everyone that's blonde will have to pay 20% less tax, and I go to the shop and buy peroxide so that I become blonde and pay 20% less tax, that's fine. Because the purpose of the law was for blonde people to pay less, and there doesn't seem to be any natural distinction between a blonde person and a black-haired person, right? You don't need to agree with what the law wanted. And this is essential because there's so many laws with tax incentives and tax benefits that we might not like politically or economically. But if the taxpayer is doing what the parliament wanted, they're not in the field of abuse, right? This is fueled by two forces, this shift. Public visibility, higher public visibility in taxes, and political interest. Obviously, where there's higher public visibility, there's an issue of legitimacy. And who feeds on legitimacy? Politicians. So if papers start reporting on corporate tax affairs, on Panama Papers, on Luxembourg Papers, on what high net worth individuals are doing with their taxes, on what corporations are doing with their taxes, politicians take notice. And once politicians take notice, the law changes, right? So this is what I call a snowball effect. Country one goes through this scheme, say the UK or the US, then its neighbors do. And then once the neighbors do, everyone wants to join the wagon. You do not want to be the only one that does not have an anti-abuse clause. And you just draft a quick anti-abuse clause, put it in your legislation, and you're part of the club. Obviously, that entails its dangers. But it is a snowball effect, and it happens in many areas of law, right? This is particularly acute after BEPS. So in case everyone here is familiar with BEPS, right? So BEPS is kind of the feeding force for the explosion that I talked about initially. Whilst the 20 to 30 years movement was moving along, BEPS put it on steroids. At the end of the day, after BEPS, this is moving at a speed which I don't think any one of us could have anticipated 2 years ago, 3 years ago. I mean, if you ask me when the multilateral instrument first came out, I didn't even think it was going to be signed. A lot of the jurisdictions that are now deeply committed to the MLI are jurisdictions that 5 years ago or 10 years ago would have been considered tax havens. So this is a powerful, powerful movement. Let's look at the case of the UK quickly. This is the UK's general anti-abuse rule. Why am I choosing this one? Because it's a paradigmatic rule. After the UK adopted it, a lot of other countries adopted it. And this text ended up having elements of it put into the MLI principal purpose test rule, elements of it put into the European Union ATAD directive, So this is kind of the mother of anti-abuse rules. And I don't say it only because my supervisor wrote it, but it is really paradigmatic. So let's start first. It says, you have a tax arrangement if it's reasonable to conclude that you wanted to obtain a tax advantage, and this was the main or one of the main purposes of your transactions. And this is the connection to the MLI principal purpose test, this paragraph. Afterwards, they're telling you not all tax arrangements are wrong. The ones that are wrong are the ones that are abusive. They're abusive if it cannot be reasonably regarded as a reasonable course of action. So this language, which seems tautological, is called the double rationality or double reasonableness test. Is it reasonable to regard that this was a reasonable course of action? At this point, that means nothing, right? What tells me whether this is reasonable or not? Whether the substantive result of the arrangement is consistent with principles on which the provisions are based. Does that sound similar to what we're discussing? It's a purposive approach based on UK case law. Then you have an issue of asking, is the means by which the person achieved those results, tax results, involving one or more contrived or abnormal steps? This is a totally different world. We're no longer in the purpose test. Now, we're in something called artificiality test. Is what you're doing out of the normal? Does it seem fantasious? Is it like a fairy tale? Again, this has a lot of problems defining what's not normal, right? And then there's the third hypothesis. Are the arrangements intended to exploit shortcomings in the legislation? I call this one the handmaiden of the parliament, or the parliament's cleaner. If parliament messed up, we'll clean it for you. Whereas traditionally, under a traditional conception of law, the law was there and everyone was subject to the law, even if the law wasn't accurately drafted. But now, if parliament messes up, if you exploited that mistake, you will be, at least in the UK, within the field of abuse. That's quite a change. Let's look at the ATAT directive, so that you see the similarities between the language. This one says, a member state will ignore the arrangement if they were put in place for the main purpose, again, of obtaining a tax advantage that does what? Defeats the object or purpose of the applicable tax law. Here we're in the purpose test, first hypothesis. Are not genuine, artificiality, having regard to all relevant facts and circumstances. This means it's not automatic. You have to assess case by case. It's not an objective responsibility test. It's, in a way, subjective. Now, what's non-genuine? What's non-genuine is what's not put into place for valid commercial reasons which reflect economic reality. The problem is that you're mixing two very different things here, commerciality and artificiality, but you're putting them together under the label genuine. We'll see that later. Now, in the multilateral instrument, which we were talking about in the field of BEPS, you've got this principal purpose test. Just as a parenthesis, we are in agreement that in the multilateral instrument, if you want to prevent abuse, you have basically three paths. You either introduce a limitation of benefits clause, which can be extended, you can introduce a simplified version, or you introduce a principal purpose test. You can also choose to introduce all of them, which some countries have done. So for the principal purpose test, it says you will not get basically benefits under this tax agreement if it is reasonable to conclude that obtaining the benefit was one of the principal purposes of that arrangement, that the transaction resulted directly or indirectly in that benefit. Bear in mind that we've introduced, again, the word reasonable. Remember that the UK GAR had the double reasonableness test, so we've brought it back here. So again, you see the connection between the mother of the GARs and all of the other ones. And we also introduced the language of purpose. Now, it stretches also to this part. Is what you did in accordance with the object and purpose of the treaty? If you did, even if you obtain the tax advantage, you're fine. So this is actually less aggressive than the UK GAR, for example. Let's talk a little bit about Serbia. So before coming here, I asked Dejan, do you have a general anti-abuse rule in and of itself in Serbia? And he said, well, we've got a substance over form-ish rule. So this is a translation, right? Tax facts will be interpreted in accordance with economic substance. Simulated transactions will be disregarded. This is quite interesting because it has two different doctrines. It has form over substance, which is the judicial predecessor that we were talking about earlier, but it also has simulation, which is an entirely different doctrine, at least in terms of civil law, right? It's a Roman law concept. So what's interesting about anti-abuse provisions is that they normally tend to do a mishmash. You have jars of ingredients. Do we want simulation? Do we want abus de droit? Do we want purpose? Do we want artificiality, commerciality? And you just mix and match, like if you're creating your own pizza. And the problem is that then you have to interpret these mishmashes, even though they have different hermeneutics because they come from different schools of thoughts and they have different logic behind them, right?
I never had a trans before my name, and I'm sorry for the translation. This was just from the top of my head in a WhatsApp conversation. So
I have to quote him. I have to quote
him. I think he was right.
Right. So what's problematic about these provisions that are based on tax abuse? Probably in your mind you already have tons of questions that have sparked and are saying, goodness, this seems difficult. So the problem is that you're trying to interpret whether the actions or omissions of a taxpayer are acceptable according to what you think are objective parameters, when in reality tax rules are open textured rules. They're not closed textured rules. What do I mean by open textured rules? Open textured rules are rules that if each one of you reads the rule, will be interpreted in a different sense. If I ask you, read this rule, and then I ask you to convey the sense of the rule back to me, each one of you will tell me a slightly different version of the tale. That's an open textured rule. Closed textured rules are, for example, criminal law rules. If you kill X, you will be fined plus imprisoned for Y years. There's no open texturedness there. There might be an issue about defining the word kill, okay? But tax is normally not like that, right? Tax is generally really, really wide, really open. And all of us that work in tax know that sometimes that openness is what allows planning, right? But that openness also makes it difficult for the administration to administer tax, makes it difficult for the judiciary to see whether there was abuse, whether there was any problem, and it makes it really difficult to use and interpret these clauses correctly because they feed from this open texturedness, but they don't recognize that they do so. So they pretend to classify taxpayers in a little box when in reality no such box exists within the legal system, right? There's also the issue that I covered right at the beginning. We're not talking about morality. We're not talking about ethical or moral judgment. There's no room for that here. If there is morality or ethical judgments, they were there when the legislature drafted the law that you're now interpreting, correct? Remember that you're going to the purpose of the law. You're not going to whether this transaction seems right or wrong to your moral code, or whether you think it's ethically correct or incorrect. So let's talk about parameters for abuse. These are the ones that I was telling you are supposedly objective, but normally are not that objective once you start questioning those parameters. We have both objective parameters, which are openly objective, or at least claim to be objective, and you've got parameters which are subjective, and people sometimes tell you they're objective, but they're not. So let's go for the objective. Artificiality. We've already seen it in the construction of the rules. Remember the genuine wording in the ATED directive? So we have artificiality, which essentially is asking you, is what you're doing aligned with economic reality, or is it contrived? Is it fictitious, or does it correspond to the economic substance of the transaction? And this is where a substance over form approach would be in artificiality. The problem here is that tax law contains multiple rules which are artificial in and of themselves. For example, CFC rules. For example, deemed interest rules. Those rules don't exist in nature. They don't refer to natural things. They're artifices, they're fictions that law has created to understand a reality. So when someone's accusing me of being artificial because of interpreting an artificial tax provision, we're kind of in a catch-22 situation, are we not? That's my problem with artificiality. How about commerciality? Is the position ordinary or reasonable for the type of economic activity that you're engaging in? The problem, again, is business awareness, commercial awareness. Does the administration understand my business as well as I do? Does the administration understand my industry sector as well as I do? Does the taxpayer understand their industry as well as the others in the industry? Are they deviating from the practice of the industry and still doing something commercial? That wouldn't be wrong. The problem is that this parameter looks at averages. If you deviate from the average, bells start to ring. But you might still be doing something which is all right. It's just that you are the most aggressive bank in terms of interests. That doesn't mean that you wanted to deviate from the tax result. That just means that that's your commercial practice and that's what you're known for. So for example, everyone knows that Goldman Sachs is supposed to be more aggressive than other investment banks. Does that mean that then Goldman Sachs is engaged in tax advantage, abusive transactions? Not necessarily. You need to analyze the transaction in question. But the point is that commerciality does require a very sophisticated administration and judiciary as well. This is also an issue for the judiciary and for the prosecution or any other organism attached to adjudicating a case. So if I'm discussing, for example, financial derivatives, and someone in the administration is telling me this derivative that you created is not actually commercial, but it's just your attempt to create something that's both interest and dividend in order to circumvent the treaty, I need the person in the judiciary that's going to solve the conflict between the administration and myself to fully understand what's a financial derivative, what are the normal financial derivatives, and why would anyone come up with a hybrid derivative? Is that necessarily bad? No, it depends on the case. What if the transaction that you were engaging with is something that no one has ever done before? Let's say that you're, again, a bank and you're trying to finance Elon Musk's SpaceX rocket program. Has anyone ever done a SpaceX program before? Does anyone know how much that costs? So if I come up with an innovative scheme to finance it, and that scheme involves tax advantages, am I necessarily in the wrong because it's not commercially ordinary? Well, not necessarily, because you don't have a reference parameter. Let's go into the openly subjective. Purpose. The teleological element. What's the main purpose of the transaction? We're not looking at what was the main purpose of the legislation, right? Which was the purpose approach in the clauses. Now what we're looking at is purpose as a taxpayer. Why did you create this vehicle in jurisdiction X? Why did you open an account in Bermuda, in the Cayman Islands? Why did you create a company in the Isle of Man? Did you create a company because you wanted to use it as a stepping stone so that you could benefit from treaties A and B, where the other nation didn't have a treaty with those nations? Or did you like the Isle of Man because you have a hotel in the Isle of Man? Did you like the Bermuda because it has very good insurance regulation, which it actually does? So this is what you're trying to assess in the teleological element. What was the thought behind the taxpayer? Is that easy? Do you think that it's easy to go into the mind of the taxpayer and assess what they were trying to do? Is anyone here experienced in criminal law? There we go. Yeah, when you have to assess any crime of intent,
Yeah, it is.
really, really difficult. So we're translating the problems of other fields of law into tax. Sorry, I was missing one. Intent to betray the spirit of the law, which is the other side of it. This one is, what was the parliament intention? Am I betraying it? And the language is fascinating. Betraying the spirit of the law. It's like if the law was your best friend and now you're taking their girlfriend or something like that. So you're betraying the spirit of the law. You're not acting in good faith. Two different concepts. You shouldn't mix good faith with whether there's a mismatch with the intention of Parliament or of the treaty negotiators, and good faith. Because good faith, at least when I was taught good faith in Roman law, good faith was an issue of were you deceiving or were you in silence about what you shouldn't keep in silence. That was good faith. But this is kind of different. Okay. Let's try to move from the law to the facts. When we're trying to discuss commerciality, we know that it's an issue of commercial awareness, right? And the issue is that commercial awareness has two facets. Facet A, company-specific commercial awareness. Again, the example that I gave you of an unnamed investment bank. And sector-specific investment banking. You need the interpreters of the law to be fully conversant in both types of commercial awareness. Sometimes you'll come up with cases, in which, let's say someone in the administration, for example, is very experienced in dealing with the oil and energy sector. But the problem is that they've never engaged in international tax. Or you've got an issue where someone is very conversant with the oil and energy sector, but they've never had anything to do with pharmaceuticals. And then they'll have to do a transfer pricing case in the pharmaceutical sector. That person, even though they might have 20, 30 years experience and they're an absolute wizard when it comes to oil and gas, might struggle finding the chain of value in the pharmaceutical sector. In the company-specific case, if you've all your life worked in an industry sector, but you've all only worked with those in that sector that have a typical behavior, you might not understand the behavior of a company that deviates from the standard. This is an issue when you're dealing with startups. It's not the same if you're someone that has been accustomed to dealing with Microsoft, which is already an established IT, than if you're dealing with a company that opened 1 year ago and is dealing with cryptocurrency. They don't behave the same way. And there's evidence, for example, to say that most startups have a more aggressive tax behavior than consolidated firms. And that has obvious reasons. If you're consolidated, you're already listed, you have scrutiny, and you have responsibilities which a startup doesn't have. So you cannot be as aggressive because that will have consequences, right? Whereas startups either explode or they fail miserably, right? So they're willing to do a lot more to not be in the fail miserably pool. And in the main purpose analysis, or the good faith intention analysis, again, what was the taxpayer thinking? And here I have a fascinating question to introduce the next part of the presentation. Do corporations have a mind? Thus far, we've been thinking about individuals. Clearly, individuals have a mind, and I can assess and prod the mind of that individual. How about a legal entity? Does it have a mind of its own? And if it does, how do I assess it? And generally, these cases will involve corporations, trusts, private interest foundations, partnerships, in addition to the traditional high net worth individuals. So let's try to think a little bit about how a corporation behaves. I'd like to call this corporate tax culture. So a corporation's tax culture, I believe, is the union between two aspects of its approach to taxes. How it behaves in relation to taxes and how it thinks in relation to taxes. Therefore, the importance of do not confuse morality with morale. Remember that morale is just ideology, how you process a concept. So, in the case of the concept, company X, how do you understand taxes? How do you perceive authorities? What's your appetite for tax risk? These are all normative elements, ideological elements. They're not manifested immediately. They're manifested when they become tax behavior. The tax positions that you chose at a tactical level, day-to-day level, your tax contribution, how much tax did you pay or how much refund did you pay, did you get back? How much did you carry over in terms of losses, gains? And again, how do you actually relate to the authorities? Are you confrontational? Are you cooperative? Do you hide until the last moment? Do you seek the administration's counsel before you act? All of these questions involve a corporation's tax culture, and I believe that each corporation has a different tax culture. And for me, that's what a corporation's mind is. So even within the same sector, if you go to the pharma sector, will pharmaceutical A and pharmaceutical B have exactly the same tax behavior and tax morale? I don't think so. I think they'll have similarities because they are within the same sector, of course, but there will be differences in those companies. And it is in unearthing those differences that you understand a little bit more about how that corporation will behave tax-wise. It's also an issue of tax governance, right? What's the structure within your corporation that determines whether a tax position is acceptable or not acceptable? What's the structure that tells you whether this is too risky or not? If you're in the tax department within your corporation, who oversees you? Who tells you, that sounds fishy, stay away from that? Or who tells you, I need more money, give me more tax refunds, do whatever you want, but give me the refund? That sort of thing, yeah.
Would it be fair to have an arrow from tax morale to tax behavior?
Certainly.
Because obviously this is not something independent.
Yeah, they're not independent, but there are two aspects.
Fair enough, but it's sequential. So basically the causality goes from tax morale to tax behavior. This is not the only explanatory variable of tax behavior.
Oh no, there's a ton. Yeah.
Of course.
Yeah.
But it starts from tax morale.
Yeah, I would actually also say that it's a loop. There's also behavior that leads to tax morale. So, for example, I have interviewed corporate executives, corporate tax directors in very large corporations that say, before I joined company X, I thought of tax this way. After being in company Y and experiencing company's Y behavior, I have changed the way in which I see tax. And that change will then be fed back to wherever this guy works. So I do agree with you. There's more interactions, but I would say that they're bilateral. Yeah, there's a loop.
Of course, there is a feedback, but
Yes.
it seems to me that the main causality goes from tax morale to tax behavior.
Yeah. Okay.
That's assumption.
Yeah. So let's talk about determinants or factors associated with tax culture. Again, part of what we were discussing, there's so many variables that influence the corporation. On the one hand, you've got macro or contextual factors. You've got the legal system, you've got the country where you operate, and you cannot detach yourself from it. It's different to operate in Serbia than it is to operate in Austria. It's different to operate in Austria than it is to operate in India. You've got, in addition here, you've got the administration in and of itself. That's a macro factor. What type of administration are you facing when you're acting as a taxpayer? You've got organizational factors, so company-specific factors. Again, the governance, the ownership, how old is the company, where in the world did that company originate, where are the dividends going back to, the industry sector that the company belongs to. There's so many factors at the organizational level as well. And you've got this third level, which is the individual level, the micro. If you want to think of it in terms of magnitude, this is a macro, this is a meso, and this is a micro level. So in terms of the individuals, it's not only the tax director. The tax director is certainly a key part of the puzzle. But the tax director is influenced by the board. The tax director is normally influenced by external tax advisors. the tax director is influenced by the CEO, by the CFO, in most cases really by the CFO. So, and also colleagues. Occupational networks are essential in determining a person's tax morale. What you're doing here is an exercise of belonging in an occupational network. What I'm telling you here, as a colleague of yours, might or might not influence what you do and what you think about. So definitely occupational networks are something which contributes to creating personal norms and social norms, which will then impact these key individuals. So I want to talk to you a little bit about my own research so that we see a little bit of the theory that we've discussed or the ideas that we've discussed down at the ground level. So I want to show you some results of empirical research carried out in the past 2 years with very large corporations, multiple economic sectors, all of them multinational corporations with different ownership structures. Some are listed, some are not. Some are partnerships, some are C Corps, and corporate tax directors of these corporations into similar and different countries. Similar in that they have a worldwide system of taxation. The UK has a more territorial system nowadays, but it maintains as a principle the worldwide system. It's just that you can opt out of the worldwide system and choose a participation exemption for territoriality. But they're different in the macro levels, right? Colombia is a mid-high income country, not a high income country. Obviously the UK is a high income country. Different governance, different judiciary, and really, really different administrations. HMRC, so Her Majesty's Revenue and Customs, the UK's administration, is really different than DIAN, which is Colombia's authority. DIAN, Colombia's authority, operates under a command and control type of regulation, whereas HMRC has adopted cooperative regulation. And that's a world of difference in terms of how a taxpayer behaves. So that's what I'm saying there about compliance paradigms. You're thinking about different paradigms. So my comparative research was trying to say, if I go into these very large corporations, some of which actually operate in both countries, and I talk to the tax directors of these corporations about, amongst others, abuse, risk, other topics, will I find different patterns or will I find common trends? So that's a little bit about what I'm trying to talk here. Yeah. Let's look at some of the individual factors, personal norms, at the micro level that we were discussing. The hypothesis is that risk aversion and compliance are tied with the way in which key individuals in that organization see tax morale. But how do I assess how they see tax? I ask them a simple question. What's your personal objective when it comes to your work in this organization? What do you seek to achieve? Would you consider your work has been properly done if what happens? In the UK, these are direct quotes, right? So that you can see that I'm not making stuff up. This is direct from what they said. Obviously, their names are anonymous. So in the UK, one of the main themes, several directors said, for us, the main goal is risk aversion. We don't want any surprises. We want no contingencies, and this means, in the case of this person, giving reliable guidance. We are a publicly listed company, and the analysts and shareholders, so the stakeholders, want to know the numbers, and I want to avoid surprises. Make sure that everything is robust, supported, no nasty surprises and audits. This is a risk-based approach, but this is a risk-based approach from a person that's risk-averse. Compliance, that's the other main theme in UK tax directors. My main objective, says this person, is to ensure that we tax effect every transaction in an appropriate way, that we don't miss anything, that we are accurate in our compliance and report completely and accurately to external stakeholders. This is this person's declaration of faith. That's what they seek to do when they go to work.
Just a quick question, was that anonymous? Were they relaxed talking to you?
Yeah, I had to guarantee anonymity to them, so you see their names are just P1, 2, 3, 4. I know the names, no one else does. I had to encrypt the info. I had to, this is a parenthesis, but Oxford has parameters for ethical research, and I had to go through the same parameters that medical research undergoes when they give you a clearance for ethical research. So part of it involves, can you guarantee these people that their name will not come out? Because we're a closely knit community. If someone tells me something that will then hurt their professional chances or will hurt their employer.
But did you get a feeling that someone was lying to you?
I got a feeling sometimes that what they were saying was scripted, which is different to lying, right? I'm pretty sure that sometimes what they were producing had been thought about previously.
Launder.
Yeah. Now, I would say that for the greater part, they were candid. And I can also tell you this based on the amount of time that they gave me. These are extremely busy people. And it's very hard for them to give you 15 minutes for this type of research. Some of them would talk for 2 hours. In a way, I was like a wailing wall. Because they know that their identity is not disclosed. They could tell me all sorts of things. A lot of them told me anecdotes which, you can't really make up. They would tell me sometimes actual positions. It's just that you have to eliminate in the text of my research any reference that might lead to reverse identification. But to answer your question, because I'm digressing there, I think that they were mostly candid. Yeah. In the case of Colombia, when asked the same question, you start seeing some differences. I classified Colombians in 3 groups. Some of them are risk mitigators, so pretty much like the UK's no surprise people. Some of them are tax minimizers, openly saying, I want as little tax as possible, and that's my goal, plainly and simply. I feel very satisfied when I know that my tax strategy and planning were efficient. It's about saving money. So the code under which this tax minimizers work is efficiency, not risk. And there's some which are multitaskers, which is a little bit of both. We cannot afford the luxury of non-compliance, so we try to have an adequate tax planning. We try to support positions which don't place the corporation under risk, so you do have the element of mitigation. But we do try to optimize. We are framing that within the context of what the taxation of a corporation such as this one should be. And that's the morality approach, not morale. So they are trying to optimize, but they are trying to mitigate the risk out of that optimization. This person doesn't even tell me about mitigation in their quick answer. They might if they script it, but in their quick answer, they don't. They just tell me I want efficiency.
There is no risk in the answer.
No.
There is no word risk
No.
in the answer.
Not at all, no. Just efficiency.
And the answer is short.
Yeah. Well, yeah.
If you deal with efficiency, it's short.
Right. Let's try one variable at the organizational level. How are tax executives remunerated? How are they evaluated? Does anyone know a little bit about agency theory? This is an agency issue. When you're an executive, part of what influences you to decide A or B is the incentives that you're given. And in this case, incentives are how much money goes in your pocket and what your position or continuation in that firm is. So, are you being incentivized to be risk averse, to be risk prone? Are you incentivized to comply? Are you incentivized not to comply? In the case of Colombia, there's still persistent use of tax-related key performance indicators, both to evaluate and to remunerate tax directors. So for example, their variable compensation will be attached to tax savings. Their variable compensation will be attached to the tax reserve. How big is the tax reserve in the financial statements? Many, many factors associated to tax. It has been going down. That's what the directors were saying, but it's still there. Whereas in the UK, there's a clear progression away from tax-related key performance indicators. This has to do with country-specific factors as well. The UK has quite aggressive penalties for what they call enablers of tax avoidance, for example. And they also have single accounting officer regimes, which are really quite nasty, and they have to do with this sort of thing. So if you come out in paper, because you have to announce, for example, how you're remunerating your chief tax director in your financial statements, and you're putting in paper that part of what you're remunerating them on is on the tax savings, that would not survive a shareholder meeting. That would not survive a board meeting. So they've learned to go away from those incentives. They have others. So, for example, they encourage tax directors to achieve accuracy in tax prediction. So, as a tax director, you'll be well remunerated if the effective tax rate that you had foreseen is the one that is there at the end of the year. Not, as it used to be, if you achieve an ETR of under X, but rather being close to what you said it would be. It doesn't matter if it's high. So that is a huge change in incentives. In Colombia, we're still generally thinking about higher tax savings as an incentive. And this obviously increases risk proneness. Yeah. Oh, again, does anyone know how tax directors are remunerated here?
I've seen that tax directors are being evaluated based on some tax savings, but never remunerated based on tax savings.
Right, so one of the two legs.
Receiving.
One of the two legs. But they would be promoted if they achieved.
Like a part of it, evaluation.
Yeah. Okay, the incentive.
And I've seen it only once, actually.
Yeah.
So it's very rare. I would say, I mean, just for you to understand in
Yeah.
general, only big multinational firms in Serbia have actually tax directors.
Okay.
Others would only have CFOs and chief accountants,
Yeah.
right? CFOs are not normally assessed or remunerated based on tax
tax, yeah.
savings. It's more like overall financial
Yeah.
results or some particularities of the like business segments or whatever.
Yeah.
And chief accountants are normally remunerated or evaluated based on compliance. So it's quite rare to see tax savings or in particular tax compliance being one of the things that you're being evaluated or remunerating on.
Right.
So there's not a lot of tax directors in general, so I've seen only rare cases where they're evaluated or remunerated based on tax savings.
Well, you're actually guiding me to an interesting point, which is in many corporations, there's this strife between the finance unit and the accounting unit. Sometimes the tax unit will be separate from those, but where it's not, in many cases, you will see the finance division pushing towards aggressive tax behavior and the accounting division pushing towards conservative behavior, amongst others, because one of the principles of accounting is conservativeness, right? So,
That's very true.
Yeah.
That's what we see
yeah,
as well.
yeah. Right. There's another factor which is important. When is the tax element considered within the business decision-making cycle? And this is essential for the MLI principal purpose test. Why? You have tax, you have an eventual business decision, and you have non-tax business factors. What I'm asking is, when did tax come to this equation? Did it come before the other business factors, at the same time, or after? I'll give you an example. When tax comes before other business factors, someone's saying, we should open a unit of the company in country X because if we do so, we'll be able to access the tax treaty network in that country. We should open a plant there because there's a tax incentive that I can think about, which will be very nice. And then you start thinking about HR, you start thinking about your logistics chain, etc., etc. Those are examples where tax predates other factors in the business decision. And if that's the case, you might be in trouble with the PPT. Remember that it said if the tax advantage was the main purpose or one of the main purposes behind the decision, how would you know if it was a main purpose? If it came before the others in time, chances are it's one of them. Now, if it came alongside, that's the most natural process. No one's asking you to ignore tax. It would be dangerous and reckless to do so. The question is, are you assessing it next to other variables. It's perfectly fine if you establish your corporation in the Isle of Man if there's some economic reason other than tax to have that corporation there under this type of test. I'm not saying that's right or wrong, under this type of test, right? What about when tax comes after? What do you think happens there? That's the case normally where the commercial unit went ahead and did something, jumped off the gun, and then tax comes and cleans the mess up. That's normally the case, non-intentional non-compliance. So in this case you have, let's for example give you the example of a pharmaceutical company. There's a unit in the pharmaceutical company that's commercial sales, and they're very interested in getting doctors to prescribe a new medication that this pharmaceutical company produces. Their targets and their evaluation of the sellers is based on the amount of doctors that sign up to the prescription program. What is normal for this sort of person to do? Think up of perks to give the doctors to prescribe this sort of medication, wherever that's legal. I know that there's countries where you can't do that. Let's assume that you can.
Yeah, let's assume that.
Now, what if the person then thinks of giving this these doctors a benefit in kind, a trip? What if they are given a trip to a conference? That will have tax consequences for the company. Will they be able to deduct that? Even more if it was illegal in the country to make that sort of payment. The answer would be no, no deduction. That would be a tax problem caused by someone not considering tax before or during the business decision-making cycle. Right. Okay. So how...
Sorry.
Yeah.
Are you saying that in that case you wouldn't have tax abuse?
Normally not the case. Yeah.
Even though that afterwards
You might-
you found out about
No, you might have, provided the non-tax team came up with a tax abusive scheme, but that's normally not the case. Because from what I've seen, tax abuse normally requires knowledge of what you're abusing, right? You might come up with non-intentional non-compliance. You might have come up accidentally with an abusive result, but that's normally not the case, at least from what I've seen.
because you're failing the first test of the tax advantage. You were showing in the beginning.
Well, because what you're thinking of here in the case of after the fact is something happened without the knowledge of the tax department, the business decision has been taken, and now there's tax consequences to face. For that decision and the consequence to be tax abusive, it would be very unusual for the commercial non-tax teams to come up with a result that would be abusive. You would have had someone, let's say in the commercial division of Company X, that says, oh, I saw on the internet that there's this LL.M thing, and that sounds really cool because it has 0% tax for corporations. Let's just incorporate then, and we'll talk to tax tomorrow about it. But that's kind of unusual, because it would be stepping a little bit outside the zone of comfort of that commercial unit. But it would be quite usual for them to go ahead and do something which has consequences in terms of non-compliance that they didn't want. The commercial people didn't want to put the company in problems, but
They
it might
don't
happen.
care about it.
Yeah, exactly.
They just don't
Yeah,
care about it.
Yeah, that's it. Yeah. So what happens in Colombia and in the UK, in my research? In both countries, most decisions would involve tax in the middle, and that's fine. Here's what's interesting. In the UK, with very robust anti-abuse provisions, there seems to be more people willing to let tax drive the decision than in Colombia. That's quite interesting. So I asked them, what type of decisions are we talking about? When do you see yourself allowing tax to drive the business decision? There were three culprits. International relocation, which is the example that I've been using over and over. Where are we opening a subsidiary? Where are we opening a branch? B, transfer pricing. A lot of the transfer pricing decisions, they say, they're starting to price the services or goods between affiliates based on the tax result that they want rather than on the market conditions that they actually believe are there. So kind of defeating the purpose of transfer pricing in and of itself. And the other one is corporate reorganizations. So mergers and acquisitions, spin-offs. In those cases, some of them are willing to consider reorganizing their corporation from a purely tax perspective rather than non-tax perspective. So does anyone remember the issue of inversions in the US? US companies that endeavor so that a foreign company becomes their owner, even though they are the ones that bought it, just so that now they become non-US tax resident? That's a classic case where tax drives a decision. And we saw 2 years ago several cases where shareholders, when they found out about the plan, actually voted against the inversion because it was commercially not in the best interest of the company. Most of those inversions wanted US companies to become Irish companies or Swiss companies. Let's talk about risk. Part of the problem with the after the business decision conundrum is that you have the interaction between tax and non-tax teams. And that interaction can be close or it can be detached and contentious. When it's close, chances are you'll have more commercially based tax positions. When the tax team understands the business, their advice will be more commercially sound, will be more based on the reality of the company, and there's a lower chance of accidental non-compliance. Let's say that you're a tax lawyer, accountant, economist, whatever you want, working for an aeronautical industry like Airbus or whatever. Do you think that the chances of you making a mistake if you do not understand the first thing about planes are higher or lower? If you have no idea about planes and you're the tax man or woman in Airbus, do you think there will be problems of non-compliance? I can tell you now there will be. You need to understand the business, right? That's accidental non-compliance. As for intentional non-compliance, will it change if you know the business? Not really. If you're a tax professional who's willing to engage in intentional non-compliance, perhaps it might even be the case that if you know the business better, you come up with more ideas. So what happens when you have a detached or contentious interaction? What if everyone in the company's cafeteria moves tables over when the tax person comes in? Or if they really hate them? And it happens. That has problems. That leads, again, to higher accidental non-compliance, increased artificiality, and reduced commerciality. Why? Because you're isolating yourself from the structure in which you work in. It's not always because tax has done something wrong. Sometimes what happens is that everyone else assumes the idea that tax is like the police. I have heard, like I didn't put the quote here, but one of the directors, I remember it distinctly, in Colombia told me, I don't know, or people have told me in my company, that they don't know whether I work for the company or for the taxman, right? They don't trust them in some companies. They think of them as a hurdle, as an obstacle. What if the pharmaceutical guy that I was telling you about says, I spent my weekend thinking up with this great idea, we're going to take all the doctors to the conference in Hawaii, they're going to prescribe like crazy, we're going to mint this company. You tell them, look, I'm kind of sorry, but I don't think that's deductible, I don't think that we'll be able to do that. Do you think you'll be very popular in the commercial unit next day? They're going to hate your guts. So that's the scenario where you might have a detached or contentious interaction. And it is an issue that the administration has to be aware of. Because if the administration is aware of this, they can target that corporation as higher risk. Yeah. Yeah.
Wouldn't all this also depend on the morale of the company? Because if
Yeah, of course. It depends on the tone down. So, a lot of the tax directors would say, of the ones that say we have a close interaction, would tell me that interaction is the result of a lot of work trying to convince the other units that we're not the enemy, and B, someone high up telling them we're not the enemy. So you need someone in the board, you need the CEO, someone telling the rest of the company, you will hear what tax has to say, you will do what tax tells you to do, and you will respect them for it. They're your advisors, they're your partners, they will save you from trouble. You do need a change in language, and it's better if this language comes from higher up because of the upper echelons theory. For example, it will tell you if changes come from the upper echelons of a corporation, chances are it will be implemented, whereas if it doesn't, it has less pull, less authority. Yeah, I fully agree that there's more factors. Let's think about the contextual dimension. I've given you examples of the micro dimension and of the meso dimension. Let's think of the macro dimension. Remember that I said that we were in this situation because of a snowball effect, public visibility plus political interest. Let's talk about public visibility. The higher the level of public visibility corporate tax issues have in your country, the higher the political pressure will be. And that political pressure translates, for example, in changes in tax rules. If the politician thinks that changing tax rules will give them votes, they will go to Parliament and change the law. Why do you think, starting from David Cameron, etc., when that was a G20 issue, it was a G20 issue? Because they thought it would give them votes by saying, I'm protecting the revenue of the country, I'm protecting your assets from these crooked multinationals, etc., etc. We know how the tropes go. What else happens? And this one's not that obvious, but it happens. Changes in the tax administration's approach. And this is the case of the UK. Some of the findings in my research say that in the UK things were working very well until about 4 or 5 years ago when it became political. When it became political, people in the tax administration felt that they were attacked by trying to work closely with corporations. Even though they weren't doing anything wrong, they were trying to work closely with corporations because they were working under a cooperative agreement. But did the public think that? Did the public think that closeness was good? No, they talked about, does anyone know of the term sweetheart deals? Cozy deals?
Corruption.
Yeah, every day in The Guardian, in a lot of the press, you would have the same attack. This is bad for corporations. This is bad for society. This is the administration colluding. This is the corporation capturing the state. And that wasn't necessarily the case. There might have been some instances, very, very punctual, but I don't think that was the case. But what's the problem? If you're working for the administration, are you going to want to face the heat of coming up with an agreement that's going to be on The Guardian next day? No. Unless you've got a death wish? No. So that effectively changes the way in which the tax administration approaches the tax payer. So let's say that you had a meeting with your CRM. CRMs in the UK are customer relationship managers, the tax contact with large corporations. If you had a meeting with them and a month ago you had said, I've got this transaction, do you think it's clear? The person said, yeah, I think it's clear, I understand your business, we will conclude an agreement. And in the middle of this person from the administration had to face a debate in the House of Commons by the Public Accounts Committee telling them, you're not being tough enough on corporations. Do you think that agreement will come to fruition? Do you think they'll sign on the agreement when they do meet you next week? They won't. They won't because they know that if they do, they will be called back to Parliament and they will face serious trouble. So in the UK, this has led to what I would call is administrative paralysis. The administration has the tools to conclude agreements, to give legal certainty to taxpayers, but it feels too scared to do so. Even if they are convinced this is technically correct, because they don't want to face the public scrutiny. And the problem is that the public isn't always right. The public isn't always right. So it would be perfectly fine if the public was always right, because it would be a control against corruption, and it would be an issue of accountability. That's great. But the public, as we have seen, for example, with Brexit in the UK, doesn't necessarily make the best decisions, right? So That's my little political cue of the day. What's the issue of reputational risk? Again, these are the consequences at the legislative level, at the administrative level. What happens to the company? When public visibility is very high, you've got increased reputational risk in your company. Now, what's reputational risk? Essentially, the risk that my brand is damaged. It will be higher for some industries versus others. What type of industries do you think are more concerned with reputational risk?
Reputable.
Sorry?
Reputable industry.
Yeah, well, clear. Yes, assuming that they're reputable industries already. Essentially, business-to-consumer industries. The sort of industries that you would see on a day-to-day basis. The sort of industries whose brand you have on top of your mind. That's why the ranking of reputation is called top of mind.
And has there been any evidence of some of the big names that were carried through the press in the latest years have actually suffered?
Yes, there's evidence in the US that has assessed the stock price of companies following disclosure of tax problems. And what they have found is that there's a crash effect. It immediately goes down, but interestingly enough, it regains after a few days because the public opinion has cooled off.
Yes, but the stock price doesn't necessarily reflect actual consumer opinion.
It depends on the type of corporation. It might reflect analyst opinion, it might reflect institutional investor opinion. Definitely. Depends on the type of corporation. But that's the research that's available. The other type of research that I've seen is UK research in which they analyze whether the corporation's published tax strategy has changed following tax disclosure issues in the media, and it has, but usually it doesn't really mean anything. It's just changing some words. And in some cases, what has changed effectively is the organigram. So there is evidence in the UK saying that when companies have been accused of international base and erosion and profit shifting, because of having a very complex structure that involves a lot of subsidiaries and branches in places that are low tax or no tax jurisdictions, if that goes out in the media, there is evidence that they close off some of those subsidiaries.
That would basically be proof that somehow they were affected, their own reactions.
Yeah, because otherwise you wouldn't go through the cost of it, of course. Yeah. But then again, this is based on the evidence of what the directors were telling me, so this is something that worries them. So there's another type of industry in which this is a huge concern, public procurement industries. If your first customer is the state, the last thing you want to do is be in trouble with the state. So what you will actually see in some public procurement companies is that their tax behavior will be so conservative that it's actually over-compliance. They're paying more than what they should. They're not paying all the deductions they have the right to take because they don't want to stir up the waters. They want to be absolutely out of the radar. And that's the instruction that you get from the board.
Just one question regarding reputational risk. I'm not sure whether the reputation is what's influencing the drop in the stock price. If it were me, I would be thinking, okay, so there is a cash risk involved, so there is a scheme that might potentially lead to some tax penalties, etc., etc.
Yeah.
And this is why the price drops.
Yeah, and that would be what an analyst or an institutional investor would think, not a mom and pop investor. Yeah, because mom and pop investors will not read the cash flow statement or will not concern themselves with issues such as deferred taxation. But I do agree with you wholeheartedly that those who do read the financial statements will also be considering the impact of potential tax contingencies, definitely, both in terms of cash and even non-cash payments. So just deferral will also be a problem because it will capture returns whenever you do have money to return, right? So I agree there, but the main finding though is that it eventually came back, right? It doesn't really, I mean, it matters if you were the one that was having stock options exercised in between, if you were the one having your salary paid in reference to the price of the company in between, or the company was being sold or something like that. But for most institutional investors, they'll just sit and wait. So one case that I can think of is Apple, and I can actually think of it without telling you the exact numbers, but I know this is so. When Apple was first revealed to be in problems with the EU regarding the Irish state aid case, its stock market price in the US tanked, if I'm not mistaken, 3 to 5 points. Because someone was thinking this is a 14 billion hit, at least. But people didn't stop buying iPhones. What happened a couple weeks after? What has happened to Apple's stock price in the last year? Serious growth.
There is a,
It didn't stick.
there
It
is
didn't
another
stick.
company. I mean, the richest person currently is Jeff Bezos, and Amazon
Yeah,
was
Amazon.
also hit with some bad news in tax areas. And
Yeah.
obviously didn't last too
How
long.
many companies do you have like Amazon or Apple? I mean, you should also look at the structure of the industry. For
Yeah.
example, if it's an oligopoly where you have telecom companies, for example, in US you have Verizon, AT&T,
Yeah.
T-Mobile, there's not a lot of, a big number of small competitors.
Yeah.
Whereas in other industries you have a large number of small competitors that can easily be wiped out.
Yeah.
So there should also be taken
Yeah, I
into
think
account.
that the results would change. I think that the problem is that the methodology of the study in the U.S. was based on averages in the stock market, so that would include companies of a lot of different characteristics. But yeah, I agree with you that if you are in a corporation, for example, you might be in a corporation that's facing financial stress, and if that happens to a corporation in financial stress, a 3 or 5% will kill you. So
One thing that might also be looked at,
yeah.
but I don't think it's been researched, is the effect of the publication of a potential tax dispute on your costs of financing.
Yeah.
So since tax administrations like to make this more public,
Yeah.
how do your financier, your banks react the next day with respect to perhaps your variable interest rates that you're going to pay on your loans, or how accessible are the loans after this gets published, because you're suddenly becoming a high risk client, thus the rates become
Yeah,
higher
you would
which
expect.
you would borrow. So this can impact the everyday business of a company. Okay, that's again not a consumer issue, it's an institutional investor issue, but in a competitive market where you have a lot of competitors and where you're playing on small margins, the rise in your financing costs can kill you off and be very positive for the competition.
Yeah,
And
I totally
in this climate, we did have hints that actually, of course, these were unsubstantiated suspicions, but it was talked among, tax practitioners, certain circles, that some audits were actually incentivized by the competition in order to make problems for the other side.
It wouldn't be unheard of. I
Yeah.
mean, we know that it's the case in trust law. It's common for whistleblowers to actually belong to the company that's outside the trust, outside the cartel. Yeah, I totally think that that's feasible. I think that also will, in at least in the EU cases, there's other factors at play.
Of course.
There's political factors as well, I think.
Just one question, in tax law, when tax law is breached, then there is a fine. Is that fine proportional to the turnover of the company?
It depends on the country. In some countries it might be an issue of turnover. In some countries it's just an issue of the quantum of what was defaulted or what was seen not to be paid. In some countries it's a fixed fee. So it depends on the country, but there are some which do base it on turnover. I've seen other countries which what they do is they create a period. So they'll say, for example, if you failed to file the return from day 2 to day 12, they'll get 10 days of turnover and sanction you on those 10 days of turnover. Or sometimes they'll say if you didn't report your numbers correctly, we'll fine you with a 1% of your turnover.
I mean, the reason I'm asking this
Yeah.
is that in competition law,
Yeah.
in which there are similar line of reasoning of shareholders, that the fee is, in principle, always proportional to the turnover. So basically, the fee paid by Microsoft and all other
Yeah.
firms that are fined by EC it is proportional to the turnover. So that is my question based on the issue of market structure. To what extent market structure is important for this consideration?
Well, I think that at least in the state aid cases, the way in which they calculated what Apple had to pay back was actually, in my opinion, one of the most strange parts of the decision. Because the way in which it's calculated is supposed to be on what the ideal system that Ireland should have used before the transfer pricing guidelines existed, that the union wanted to be used, should have been applied, not on a market distortion basis. So I think that in competition law, the advantage is that you normally have better studies of market distortion. And you also have, okay. But in this decision, it was definitely not there. No one told me that the 14 billion was based on any of Apple's competitors actually losing 14 billion or anything equivalent in terms of market. And it wasn't technically justified, again, in my opinion, that Apple failed to pay 14 billion to the Irish authorities. It was an approximation of what they thought the price of transactions should have been, no consideration with what that impact would have on the structure of the market. Right. In the case of corporate tax culture, it's key for us to think of board involvement. Are we having a conservative tax approach from the board down? Is it an issue of cosmetic compliance? What do I mean by cosmetic compliance? Am I gonna superficially mix up the words in my tax strategy so that they don't bother me anymore? Because I can just copy paste the text of the UK GAR on my tax strategy and say, I will always act reasonably whenever I'm thinking, literally verbatim. And that can be my tax strategy. Does that mean that I'm actually complying in the way in which the law wanted me to comply? Not necessarily. You can also resist or detach. It's just that that has effects. As a board, you might decide, I couldn't care less what the NGOs say about me. I couldn't care less what the papers say about me. They're wrong. They don't understand the technical aspect, this political, whatever. But that has consequences. But some companies might be willing to undertake those consequences. I know that, for example, some of the companies in the mining sector were quite upset because certain NGOs were accusing them of not having paid the right prices for their commodities when they were being extracted mostly in the developing world. And they said, technically, I think they're wrong. Technically, I think that I've paid what I had to pay, where I had to pay it. They commissioned their own extractive CBC reports, which predated the actual CBCs that are coming out now. But when the public saw this commissioned extractive sector CBCs, they weren't happy. Their reaction was even worse. Oh, you're now just trying to deceive us. You're now just coming up with this bogus study telling us that country X should have received Y when it should have received 3Y or 4Y in taxes. You're part of the establishment that's trying to deceive me. Essentially, this document is fake news. So if you're in the board of a company that faces this, some of them just said, you know what, I'm not going to keep trying to convince them. My fight is with the tax administration. I know that I'm technically right. That's it. But again, that's a very particular case, and you have to have exhausted the idea of trying to convince people that what you were doing was right, or actually change to a conservative tax approach. Okay? So, in the UK, this was a big difference. When I asked tax directors in the UK, is public perception taken into account when you devise tax strategies in your corporation? Huge yes, 81%, 19% no. Again, that has to do with the context of the UK. The sort of scrutiny that the media exert on corporate tax affairs in the UK, you don't see, I haven't seen anywhere else. Every day they'll be talking about it. So that means that you have to be more conscious. In Colombia, only 47% of tax directors said, in my corporation, we care about public perception when thinking about our tax strategies. Some of them said, sometimes we do, sometimes we don't. And 24% said no, not at all. That has to do as well with the type of rules that you have in both countries. It's not only about the media. Like I told you, in the UK you have anti-enabler penalties, you have accountancy officer penalties, you have practitioner penalties in the UK. So hands are bounded. Also the administration, again, because of public and political pressure, will act differently in relation to anything that smells like abuse. Whereas in Colombia, even though we have a lot of anti-abuse rules, we don't necessarily have the same type of penalties that has an effect in terms of deterrence. Again, the administration is not being as publicly scrutinized and, dare I say, prosecuted. So that's bad for accountability, but that's good for cooperative compliance. What about the perception of the authorities? Both compliance-mindedness, whether you're willing and wanting to comply, and your risk appetite are heavily influenced by the perception of the authorities that that taxpayer has. If you see the tax authority as illegitimate, as incompetent, as untrustworthy, are you going to relate positively to that administration? No. Vice versa, if you think they're trustworthy, competent, and supportive, you will engage with them. And the result will be different in terms of tax outcomes. It will be different. In terms of deterrence, taxpayers tend to assess the probability of being caught. The equation that taxpayers are thinking about is what's the tax, what's the possibility of being detected, and if I'm detected, what are the range of penalties available? So obviously, if you think the administration's powerful, you're less inclined to engage in aggressive tax behavior. So this is this element here, which is the power dimension. And power involves two elements. Are you detecting non-compliance, and are you acting when you detect non-compliance, so enforcement? And this is deterrence, but that's only half of the picture. You also need the component of trust. A, do you think that the authority is acting in the public interest, or do you think that they have their own agenda? If you think they have their own agenda, even if you think they're powerful, you might choose to resist because you dislike their agenda. Attitude. Even if the administration is not powerful, you might choose to comply if you think the administration is doing whatever it can and it's doing so nicely. Because sometimes we recognize that administrations don't have the resources. So you're admitting that, hey, sometimes it's expensive, it's difficult, I'll help you. Even though I don't have to. I know that you won't catch me. But what's the point? You're a nice guy, I'll help you out. And it does happen. I know that it sounds a little bit off, but it does happen. Reliability. Is the administration reliable? Will they behave in the same way year after year? And that's essential if you're a businessman, reliability. You want to plan your cash flows, long-term, mid-term. You want to know your deferred tax. If the administration tells me this year that my remuneration policy for directives is great, but next year it tells me that what I was doing was abusive, am I going to trust them the next time I ask them whether my policy is fine? Probably not. Because they've already shown me that they're flaky. So reliability is important. So let's think about what the directives, executive tax directors told me in those two countries when I asked them about these two factors. Initially, I asked them, what's your perception about the authority in terms of power, about their ability to discover and act upon non-compliance? Now, HMRC is a very powerful tax administration, I would say. What do you think directors said? 27% of them thought it was strong. 27% thought it was weak, and the majority of them thought it was mixed. What does that mean? It's strong in one of the two dimensions, which is hilarious. So some of them said it's not strong when it comes to detecting non-compliance, but when they do detect it, you're done. That's the general answer, right? It might happen inversely. You're very strong at detecting, But if you don't have the right prosecution, if you don't have the right judiciary, being strong at detecting is useless because there's no actual penalties, no actual deterrence. What do you think happened in Colombia? Huge, weak perception. Again, the resources available are not the same. They're not the same. If you are talking about the case that I told you about, financial derivatives or a complex transfer pricing case, the number of staff in the administration that's qualified to engage in that case is low in comparison to that of the UK. You have lower IT resources as well, lower financial resources. You have a deficit of resources all over the place. So it's natural that you will be perceived as weak. We talked about the shadow economy. Do you think that anyone perceives the administration as strong in a country that has a 60% shadow economy? One of two transactions is going under the table, so clearly not. Now, what about trust? This one again is fascinating. Look at the blue number in the UK. 73% of UK tax directors trust HMRC. Whereas in Colombia, 56% don't trust the administration. This is not only because we're talking about Colombia and the UK. Remember that I told you Colombia and the UK have different compliance systems? The UK works under cooperative compliance. They try to work with the taxpayer. We've said that it's starting to have problems because the administration is scared to do so. But the fact is that they've had this system since 2010. The effect of that, plus, of course, a contextual tradition in the UK of trusting the authorities, means that you have those numbers. Whereas in Colombia, you have a command and control approach. A command and control approach is more typical of the police than of a tax authority nowadays. If you have a command and control approach, you do not treat your regulatory subject softly. You treat them as a potential suspect, as a potential defaulter.
I think our colleagues, one of our colleagues mentioned this, but this is something which might be close to relate the Colombian and the Serbian experience, is that I think, and I'm not from the corporate sector, but I have worked with it, that I think that Serbian tax directors would probably feel that actually the ones who are compliant and who are trying to comply are being hit the hardest. Yeah. Because they would feel the Serbian tax administration is weak, as unable to detect or implement all the provisions that it should. It is unable to prevent the shadow economy.
Yeah.
And then since it has to fill in the budget, it has to fill in the state coffers, yeah, it goes after those who are already visible in there and who are compliant, and they're trying to, basically get more money from them. And I think this is where the lack of trust would also come, because they would say, well, if I come to you, you're just going to be worse to me because you're unable to do your own job fully, so I'm paying the price for that.
Yeah, I totally agree. I mean, if I could show you quotes here, they would have verbatim what you're telling me. They would say the administration always comes after the good guys. We have a feeling that it's not worth it to comply when we know that our neighbor that's not complying will never be caught. And at least in the case of Colombia, for example, it's not only an issue in corporate taxpayers, it's also an issue in high net worth taxpayers. If you have a base of 2,000 taxpayers, they're going to be grilled year after year.
There's an anecdote that says that in 2008, when the Serbian tax administration started its first comprehensive audit of corporate income tax,
yeah,
they basically put online on their website the first comprehensive audit of large taxpayers, of those who are already paying enough.
Yeah, yeah.
So they didn't even hide this.
Yeah, I agree totally. But this has effects. Right. How are we thinking about tax risk? And this is the last part. How do we assess risk? We can assess risk using non-tax specific tools in the same way that I would assess environmental risk, financial risk, any other form of risk that I call generic risk approach. Or I could use a tax specific approach built only for taxes. And it can be rigid, flexible, or balanced. When is it rigid? When I use preset, for example, risk matrices, heat maps, COSO type frameworks. Flexible, when I do it by, and this is a repeated phrase by a lot of tax directors, my gut feeling. Literally, that's what they said. I don't engage in this tax position. I think it's risky because my gut tells me it's risky. I don't need a heat map or a matrix to tell me it's risky. It's an informed gut. It's a gut based on their experience. They're there for some reason, right? But it's still a gut. So what others do is a balance. Yeah, I will use the matrix, but if the result that the matrix gives me, my gut tells me that's absurd, I'll disregard it. Or if my gut tells me this is risky, there's no point in doing the matrix. I'll just say risk. I won't do the actual calculation, but I'll leave it an evidence in the matrix saying I thought this was risky. Most companies engage in a balanced approach or actually a flexible approach. So the minority is a rigid approach, but it's been growing. And it has to do with legislation that asks you for this product. Do you have your tax risk matrix? You have to give it to the authorities every X months in some countries. Well, how is risk measured? And this is really difficult. Do I measure the probability of the administration challenging the transaction? Do I measure the probability of overcoming the administrative challenge, of having them reconsider their decision? Do I base myself on the probability of overturning it before the judiciary? Even more aggressive and more unfathomable? Or do I base myself on the probability of causing reputational damage regardless of what the authorities think? If this is leaked out to the media, what will happen? And this is what UK executives call the Daily Mail test, or the financial test, Financial Times test. They actually use that word, or that term. Am I going to be embarrassed and out of a job if this appears in the news tomorrow? If that's the case, I'm not getting into that transaction. I don't care what HMRC says. I don't care what the judiciary says. Now, who evaluates risk? Remember our agency issues about evaluation, remuneration, and governance? Who's going to tell me whether this makes sense or not? Is it going to be the tax department, the finance, legal, the board, which generally doesn't have tax experts? Perhaps the CFO, if they have some. Perhaps if it's a very large corporation, a chief tax officer, which is highly unusual. Or will it be the external advisors? That's a huge factor. Are you going to be the ones telling them, get off, that's risky? I think that's likely in many cases, especially smaller companies. What do you base the acceptability of a position on? What does this gut tell us? Are you basing it on legality? This doesn't seem to go with the law. Are you taking a literal approach? The letter of the law says that this is Y and this is X, so I'm not going with it. Are you going to a purposive approach? So are you doing the purpose and intent analysis? Are you thinking, is this what the legislature wanted me to do? Is this what they wanted me to achieve? But this is really difficult. How can you know what the legislature wanted? Unless you actually have the legislative drafting materials in which they said, I want this with this law, which is sometimes available depending on the country, it becomes very difficult to try and predict. Is it an issue of commerciality? Are we talking about industry sector benchmarking? So what does this mean? Will I do this? What does my competitor do? A, B, C, D. Do they do this? Yep, then I'll do it as well, because I don't want to be the sucker that doesn't do it. At the same time, I don't want to be the first one that does something aggressive. I don't want to be pioneering in this. Administrative or judicial commercial awareness. Am I basing it on, do I think the administration will actually understand? One of the tax directors in a highly regulated financial industry said, look, I know that no one will understand anything that I do with this figure. We took years to understand this legislation, they said. I know that they have no one that will understand anything that I do regarding this. So I have free hands. If I want, I can do whatever. Riskiness, generally. No, I just think that this is risky. You don't have to define why. Artificiality, again, does this seem too good to be true? Does this seem weird? The example that one director told me was, if someone comes to me with a yen capitalized company in Jersey, that's weird. So, again, that's kind of common sense. Or do you actually go, what we were saying, don't go, ethics and morality? And it happens frequently. I just don't think that this is fair. I won't do it because of that. Okay, the problem is that your fairness is different from Joe Block's fairness and from the fairness of the other person sitting on the other side of the table. Sustainability. If I do this now, what will happen in 2, 3, 4, 5 years? Am I going to be in trouble in 5 years? Am I going to leave the mess to the next tax director taking my position? Some will be okay with it. Some won't. Right. Now I want you to do something for me. It's going to take 2 minutes, but it's going to be really interesting. So I know that it's almost over, you're tired, so buckle up. It's 2 minutes of your attention for this. I'm going to give you a hypothesis, then I'm going to give you 2 types of tax behaviors, 2 taxpayers that engaged with this law, and you're going to tell me 2 things. A, did they engage in something acceptable? And B, would you do it? I just need a show of hands. And this is not a Serbian law. This is nothing that can tie anyone onto anything. So I'll tell you the hypothesis. You've got an economic recession. So the legislature comes up with this law. And they say it's aimed at boosting economic productivity because we're in a recession. This is what the law says. Taxpayers who acquire fixed, productive, real assets, right? Fixed, productive, real assets can claim as a discount in the year of acquisition a tax credit for 40% of the acquisition's value in addition to depreciation. So if you bought a real, fixed, productive asset for 100, you can claim 40 back in addition to depreciation.
Yeah, we had that until a couple of years ago, so I think everyone's perfectly...
Great. You had it. That's great. It still works. This is the question that I asked executives. I was not thinking of the Serbian case. There's no other conditions, right? Does anyone have that clear?
Yeah.
Right. Now, first taxpayer. You're a corporation dedicated to manufacturing computer hardware. That's what you do. You buy a fleet of Mercedes-Benz sedans to transport your directive personnel, so everyone in the board and all of the directors in the company. That's $1 million, $2 million, whatever, and you're going to claim 40% on that against your tax. First, think about it for a couple seconds. Show of hands. Who thinks this is not acceptable? Does anyone think it's acceptable? Really? Okay, that's great. 1, 2, 3, right, about 10%. Would you do it? Yes? The ones that said it's acceptable, they would do it. The ones that say it's not acceptable, would they still do it? Because they think it's low risk? No? No one changes their ideas? Okay. We'll do the second one and then I'll show you what the actual directors said. And explain what they said as well. The second one, you've got a law firm, and it purchased 20 high-end network servers. Subsequently sold them a week after and claimed the credit. Again, show of hands. Is this acceptable? Yes? No one? One. Is this not acceptable? Everyone else. Right. Just very quickly. Which factor led you to say immediately that's not acceptable in the case of the ones that did?
I'm troubled by the high-end network servers and flipping over very soon. Do they qualify as a fixed asset? Is this just like a,
You're thinking of the literality of the
Yes,
norm.
yes.
So legality is your principle.
Well, not legality.
Or is it also artificiality?
Actually, I'm driven by Serbian law. because
Yeah.
I'm driven by Serbian law, because what they would look at here is, and I think, and in both cases, we didn't allow the credit, I think, for automobiles. So this is number one. And the second thing is that we did look at the principal business activity.
Yeah.
So, and we linked it to it. So but we did it expressly. So I would be wavering if it didn't say expressly.
It said no other conditions.
I know. So I wouldn't go for it, but I think it's acceptable.
Right.
For me, I'd apply, let's say, a tautological interpretation of the provision, because in my view, the purpose is for the assets to be used for the productive activities.
But they're making a profit, so.
It's not a productive activity, it's a productive asset.
It's a productive, fixed, real asset.
Exactly. So, Mercedes-Benz,
It's a statement, right?
it's not exactly. It's not productive. On the other hand,
But the Mercedes-Benz is productive because it increased the productivity of the executive staff, because it makes their,
Makes them
basically, it's the fact why I get the good phone, the 2 secretaries, and I get free coffee, and you gotta go down to the cafeteria, so.
I'm convinced that if I actually offered this, I'm convinced that I would face a fight from directors if I didn't. Because of those reasons. They would say that when they won the car. But now let's see what the executives say. Let's go to the next. Look at this. Actually, almost the same number of directors in the UK said it was acceptable to buy the cars. Then not acceptable, whereas in your case only 10% of you said that it was acceptable. You are like Colombians. Purely unacceptable.
Unacceptable.
Unacceptable, said the Colombians. That's not all right. Whereas in the UK, people were, yeah, America, yeah. What did they say? Some of them had great answers. One of them said, yeah, you're in a context of economic recession. What does the legislature want? Boost economic productivity. You do not have to think only of the productivity of the company. That's a debate. Think of the productivity of the car salesman. Are we reactivating the economy? We're putting money into the economy. We're injecting it. That's great. That was how one of them justified their decision.
Yeah, but the economy is in a recession. You don't buy a Mercedes in a recession.
No, actually, South Park would say that's exactly what you do.
Well, but that's what, I'm telling you what the executives actually said. This is how they justify in their own mind how this operates. Other people focused on the literality. They said, is it real, productive? Some of them said it is productive because it will increase the motivation of the executives to work here. They won't go to other companies that cost me money to do HR. People gave me tons of explanations. Some of them said it's acceptable because it's not going to be fiscalized. It's not a risk. I don't care. It's just not a risk. There's a whole array of universes. What I'm trying to tell you here is that these decisions are never clear-cut, even though they might seem to. When people are actually taking them into consideration, sometimes they do start creating mind maps to try and justify the idea. Now, in the third case, tax savings with apparent main purpose, the law firm buying this very sophisticated equipment and selling it a week after, most people in the UK said, stay well away from that, whereas almost half of the people in Colombia were actually willing to engage in this. Now, this has to do with the context. In the UK, this type of transaction is that set going to get you jailed or in court, because the judiciary takes an approach which is explicitly against this type of purposive commercial transactions. They will assess the commerciality. You're a law firm. Why on earth are you buying this equipment? If you're going to implement artificial intelligence in your law firm, which some do, that's fine. But you wouldn't sell it a week after, right?
But for a good price.
Yeah, well, but that's what a UK judge does, and that's what HMRC does. Colombian judges and the Colombian administration thinks differently. They think very much on a legality code, not a commerciality code. So, naturally, executives there think, that's all right. I'll do it. Whereas in the first case, again with the context, the reason why Colombians were so adamant against it is because there had been
It's luxury cars.
issues with deductibility of luxury car purchases,
But you see, our
regardless of this rule.
schizophrenia is that our answer in the first is Colombian, and an answer in the second is actually UK.
Yeah.
So we're completely
You're all
insane.
over the place. You're all over the place.
But I'm
Yes,
like
you're Colombian.
Colombian.
Okay, that's it, people. Thank you. Questions?